Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching IndianOpen this Wednesday morning. Let's go straight to the headlines. Jerome Powell says protectionism can hurt economic growth but says gradual rate hikes are the best path for now. The Fed chief's upbeat assessment on the US economy lifts the US equities overnight. IDBI Bank seeks government not to bring LIC on board as a promoter. The bank CEO says the life insurer's intent is to take management control. The government will infuse over 11,000 crores in 5 state-owned banks in a week's time to help them make interest payments due on bonds. And the monsoon session of Parliament begins today. The government and the opposition are likely to lock horns on crucial bills, including RTI amendments and the triple talaq. Well, important ones from a domestic perspective, to be honest. But let's take a look at the global picture because I think it was all about the globe. US markets rallied. Powell touted strong economic growth ahead for multiple years. And I think all of that resulted in the markets coming off from the levels that they were at to close in the green. In fact, NASDAQ reached all-time highs, buoyed in part by this, part by what Amazon and some of the other tech stocks did. Amazon hit new highs and took NASDAQ to all-time highs along with it. And if you just look at what happened to the global markets across the board, first the US markets, how they did, they ended with a fair bit of green, at least the NASDAQ did, and the Dow about a 0.2% higher. Europe did reasonably okay for itself. And as I said, in part, this was attributable to what Fed Chair Jerome Powell said. He told the US lawmakers that strong economic growth lies ahead for the US markets and that will keep the central bank on a gradual rate hiking trajectory. However, he went on to warn that Trump's trade policies risk future growth if they lead to permanently higher tariffs. Listen in.
My colleagues on the FOMC and I expect that with appropriate monetary policy, the job market will remain strong and inflation will stay near 2% over the next several years. This judgment reflects several factors. First, interest rates and financial conditions more broadly remain favorable to growth. Second, our financial system is much stronger than before the crisis and is in a good position to meet the credit needs of households and businesses. Third, federal tax and spending policies likely will continue to support the expansion. And fourth, the outlook for economic growth abroad remains solid despite greater uncertainties in several parts of the world. What I have just described is what we see as the most likely path for the economy. Of course, economic outcomes that we experience often turn out to be a good deal stronger or weaker than our best forecast. For example, it is difficult to predict the ultimate outcome of current discussions over trade policy, as well as the size and timing of the economic effects of the recent changes in fiscal policy. Overall, we see the risk of the economy unexpectedly weakening as roughly balanced with the possibility of the economy growing faster than we currently anticipate. Our policies reflect the strong performance of the economy and are intended to help make sure that this trend continues. The payment of interest on balances held by banks in their accounts at the Federal Reserve has played a key role in carrying out these policies, as the current monetary policy report explains. Payment of interest on these balances is our principal tool for keeping the federal funds rate in the FOMC's target range. This tool has made it possible for us to gradually return interest rates to a more normal level without disrupting financial markets and the economy.
Well, but some strong comments lifting the US markets and thereby the impact that we're seeing on the world markets by and large as well. In fact, yesterday for our markets, the fall in oil prices was one big buoyant factor that single-handedly led to some bit of an uptick in sentiment. There was some long build-up which resumed after a bit of unwinding that we saw in Monday's session as well. Just look at what's happened. The July series, the Nifty OI and the Bank Nifty OI again started inching up. Remember, they've taken a step back at the close of Monday's session. And interestingly, now the Max OI for the July series on the call side stays at 11,000, yes, but on the put side has moved from 10,600 to 10,800. Not saying that this is the narrow band in which it will close, but the traders are now comfortable even taking writing put options at about the 10,800 strike as well. So that was some interesting data that came out from the FNO side, and we'll talk about it in a bit detail later on. The SGX Nifty indicating a start which could be marginally in the green, in line with what almost all of the world markets are saying. So we may well have that as well. So keep that at the back of your mind. And on top of everybody's mind would be what the PSU banks do. Yesterday was a big day for PSU banks. Look at that chart. The peak at the extreme left end of your screen shows the performance of the PSU banking index in trade yesterday. It was the best day since April 5th, 2 years back. And that showed the kind of buoyancy that we saw in the PSU banking stocks in trade yesterday. Remarkable uptick, and not led essentially by the heavyweight SBI. Yes, SBI did well because it's a heavyweight, but if you just look at what the PSU banking stocks did yesterday, SBI was the least performing stock. That's the list of the PSU banking stocks of trade yesterday. SBI up about 2.5% was did end in the green, but was the worst performing PSU banking stock. Almost all of the others, the likes of Union Bank, BOB, PNB, etc., had some massive gains. So it was an all-round performance by the PSU banks, and you never know. There could be some more in store in today's session because of the news. We'll get to that. In fact, watch out for all of these stocks. Let's tell you what the stocks should be. That should be on your radar at about 9:15 a.m. today. Well, watch out for Zee Entertainment, the Q1. Okay, first what to watch, the results that will come out today. So Ultratech Cement, not necessarily at 9:15, but at about 12:31, you will get the results from Ultratech. So that should be an interesting one. And a clutch of mid-cap IT companies, the likes of Mastech, Mindtree, and IT Tech, Sasken, will all come out with numbers. So it's a big day for mid-cap IT for sure. But that's during the day. What about 9:15 a.m.? Zee Entertainment, Q1 largely in line with estimates. Let's just see if the stock manages to inch up further from where it left off in trade yesterday. Doubtful, but you never know. Government to infuse about 11,000 crores into 5 PSU banks. So Allahabad, IOB, PNB and the others would certainly remain in focus in early morning trade today as well. Federal Bank, the reason I bring it up is because a clutch of brokerages which have come out with their notes post the results have all maintained the buoyant stance, but the language of the brokerages is very, very positive. So it should be interesting to see if Federal Bank sees some further buying after the 19% uptick yesterday. And PNC Infratech, a small name, but they've bagged an order worth 1,157 crores for a highway project in Karnataka. That's a large order win. Let's see if PNC Infratech manages to rally in the session today. And then, of course, the results like JSL and Tata Sponge, fairly decent numbers. Let's see if they rally. But on First Word today, what do we have? That's a collection of the top editorial stories that we bring to you at the start of the show. We are one step closer to an LIC IDBI Bank deal, but there is a slew of regulatory hurdles ahead. Ida Dugal tells us what could come in the way of the bailout. Lack of pricing power in the cement sector may have offset benefits from the high volume growth in the first quarter. Nikki Mirchandani tells us what analysts are pricing in specifically for Ultratech as well. And last but not the least, emerging global risks have prompted Balkrishna Industries to turn its focus to India. Darshan Mehta tells us why this preferred stock from the DI side, the management, why is it that it is cautious on growth? So all of this coming up over the next 15 minutes on First Word. Start off with IDBI Bank, the big news from yesterday evening. They've sought the government's approval to bring LIC on board as a promoter. Remember, the earlier proposal was for LIC to just be a financial investor. Giving management control to LIC would require a whole host of regulatory approvals as well. Ira Dugal reports.
We are one step closer to a deal between LIC and IDBI Bank. On Tuesday, IDBI Bank's board met and said that it is seeking permission from the government to bring in LIC as a promoter. That actually was the only incremental bit of information that came in, because until now it was being assumed that even if LIC invests up to 51% in IDBI Bank, it would be more in the nature of a financial investment and it would be pared down over a period of time. IDBI Bank has made it clear that they are seeking to come in as a promoter, and the management of IDBI Bank, which addressed a press conference after this board meeting, said that they would be looking to take management control. That is, LIC would be looking to take management control. So that's the incremental bit of information. Now let's talk a little bit about the regulatory issues. There have been a whole host of regulatory issues surrounding this deal, and there are a bunch of exemptions that are required. Some are already in place, some will still be required. We know that LIC has got an exemption from IRDA to breach that 15% threshold for taking equity stake in an individual company. So that is in place. They now have to get approval from the cabinet, which one presumes will come through relatively easily, and then they have to go to the Reserve Bank of India. The Reserve Bank of India has to perhaps ease their promoter shareholding norms. According to their promoter shareholding norms for private banks, a diversified financial institution can only hold up to 40%. Will LIC be allowed to hold hold more than that because IDBI is a stressed bank. That remains to be seen. The reason we are using the guidelines for private banks in this case is because IDBI does not fall under the same act as other PSU banks. So again, it's a question whether it would be deemed as a private bank or not. But the RBI would need to also approve LIC as fit and proper, which is its basic rule for allowing an entity to promote a bank. So all of those exemptions are still required. The capital part comes next. Should this 51% investment come through and most of it go into IDBI, IDBI will obviously benefit from it. They are desperately in need of capital. The amount of money could be as large as 20,000 crore, a bit more than that on a diluted base. That's according to Bloomberg Quinn's computation. So it's a large amount of money. It'll all be coming in from the policyholders' account. That is very clear now. But again, if it's coming from the policyholders' account, does IDBI Bank become a subsidiary of LIC or not? That remains unclear. So still a lot of unanswered questions, but we're getting closer and closer to this bailout of IDBI Bank.
Well, we'll get to know when we get to know. Thanks for that to Ira. And of course, IDBI Bank is not the only one. Remember, the PSU banks, by and large, because of the fund infusion, remain firmly in focus. I think the whole social media pack was worried about what will happen when the PNB bonds come up for payment and whether or not they'll have to dip into the reserves or otherwise. The opinion was divided. Now that the government has firmly come out and said that there is going to be some fund infusion into some of these banks in order to be able to make them meet the bond payments that they would have to, that could be some bit of relief. Though, to be honest, there is no other way out. You wouldn't have let a PSU bank default on a coupon of a bond. That's just unthinkable, to be honest, to my mind at least. So more of something that should have been expected, even though the market would have been worried, or certain quarters of the market would have been worried. Some bit of a rally has happened, some bit of a rally may be seen today. I doubt that this has the legs to take the PSU bank substantially higher from where they are right now, but that's just my opinion. You never know what could happen. Okay, let's talk about the other pack, and that is the cement companies. They made the most of the summers this year with volumes rising in the first quarter. What may have remained elusive, though, is pricing power, and that may reflect on the numbers, starting with Ultratech, which will put out its quarterly earnings today. Nikki is here to take us through what may be in store for the cement sector as a whole, and then, of course, Ultratech. Nikki, we'll get to Ultratech in a bit. It'll probably set the stage for the cement companies, but what would the quarter show for the pack at large?
Well, it's going to be a muted set of quarters that we're expecting for cement companies. Well, to sum up the trend, if I'm supposed to, then it's going to be a weak quarter in terms of the pricing ability of the companies. We're expecting higher input costs. Along with that, we're also looking at higher volume push. However, EBITDA margins for most of these companies are expected to contract on year-on-year basis, given the limited ability that these companies have in the face of the rising input cost pressures, and also the trend overall, the weak realization trend that we're looking at. First, to begin with the pricing power, let's look at the picture. On all India basis, we're looking at a 5 rupee per bag, a decline on year-on-year basis, but then we're expecting major pressure coming in from northern as well as southern regions, which have actually taken maximum cuts in this one last year. However, if you look at the volume picture, that continues to be healthy overall for the industry, given the kind of demand that we're witnessing both from the rural side as well as from the government side. So if you look at the volume picture, that's expected to be a healthy one for Ultratech, Shree Cement, North Base Shree Cement, Dalmia Bharat, and the South Base Ramco Cement. Also, if you look at going forward, the next plate that we have is in terms of the rising input cost pressures. That's the petcoke pressure, that basically the inflation that comes in from the petcoke prices, which have risen as much as 20% year-on-year basis. We're looking at a number of $112 per ton as compared to $94 per ton that we saw in June 2017. This, combined with the weak depreciating with the depreciation of rupee, is also expected to weigh down on the unitary cost or the unitary performance of most of these cement players. Also, if you look at the margin profile, as I just mentioned earlier, we're looking at a contraction coming in for most of these players, but then the big cuts or the major contraction can be looked at coming in from Ramco Cement, which is expected to have a 790 basis points contraction in its margin, followed by Ambuja Cement, ACC, and also some pressure keeping in from Ultratech Cement.
Interesting. But what is Ultratech likely to show today, Nikki?
Well, we are expecting the same set of numbers, muted set of numbers coming in from the company. If you look at the top line growth, however, that is expected to show a good 30% growth to a number of around 8,655 odd crore. And if you look at the EBITDA performance, that is, however, expected to be flat at 1,555 crore as compared to 1,560 crore, pretty much flat. Margins, however, expected to contract for this counter to a number of around 18% as compared to 23.5%. While that of profitability, we're looking at a 35% downtick at a number of 581 crore as compared to 890. Now, do remember the fact that besides the input pressures, we're also looking at higher finance as well as depreciation costs coming in for Ultratech Cement, and the other parameters which are equally important and we'll keep an eye out will be the volume figure, which is expected to be 35% higher, mainly on account of the merger or the takeover of the JP acquisition, the JP assets. On back of that, we're looking at EBITDA per ton. Again, the unitary cost is expected to be weighed down by the power fuel cost, which is expected to be seeing a 27% kind of downtick. And also, if you look at the last parameter that we have, that is the realization per ton, due to limited, due to the weak pricing power and the limited ability of the company passing through the kind of cost inflation it's seeing in terms of its prices, that is expected to be at a number of around 4,946 rupees per ton.
Okay, Nikki, thanks for putting that into perspective. So Ultratech, even though the volumes will show a good number, the overall numbers could well be muted. This is already factored in now. Let's wait and watch if this changes and whether the company can actually beat estimates on their EBITDA front due to better cost control. Last piece on First Word today is on Balkrishna Industries. Now, they have had a stupendous run lately, but the party is unlikely to continue. The management has thrown light on a number of risks that are emerging for the company, which has prompted the tire maker to turn its focus to India from its export markets. The reason why we're bringing this to you on First Word is because Darshan Mehta has gone through the annual report and gotten us some key takeaways, not something that we usually see. Darshan, what prompted you to look at the annual report of Balkrishna, and what are the key takeaways?
Yeah, so what prompted me was the fact that they've turned cautious on the export market. And for a company which for whose 85% of the revenue comes in from the export market, that's very, very sizable. Balkrishna has always traded at a premium to the other tire makers, given the fact that they are into the off-highway tires and they have a substantially superior margin. Now, what they've said, basically in terms of the financials, 85% of the revenues come in from the export market, and 33% of the revenues is exposed to cyclical risk. That is what the management said. Overall, they're saying that the industry growth is anywhere between 4 to 5%, and it's been witnessing positive momentum over the past 2 years. Right now, it seems to be on the cautious side. Now, one important factor that they pointed out, and I'll name a few, is carbon black, which is one of the key raw materials that they have. There are a lot of challenging in terms of sourcing this. Prices are up by almost 20% in the near term. They have taken risks to hedge this. They've commissioned a plant in India, but that will still come in at the end of the fiscal. So, till that time, they will have to make way with price increase as far as their raw materials is concerned. The other part is the outlook for FY19. What are they saying? That, business environment across the globe for them is looking challenging. They're saying that few of the geographies have now started showing signs of cooling off as far as the economic activity is concerned, and they are endeavoring to promote growth. Probably that will come in this year. So they're not very sure that probably growth will come in. 4 reasons they have stated why the outlook looks bleak and business environment is challenging. First of all is the geopolitical situation across the world. You've seen what exactly is happening. Second is because of the trade tariff and protectionism adopted by a lot of countries. That is something that is impacting them. Rising crude prices and rising interest costs. So these are the 4 factors that they've explicitly put out in the annual report, indicating that these are pressure times for them. But they've also at the same time come out with avenues where they believe growth will come in. First of all, they're looking at the deeper penetration within the Indian markets. the markets in India are just 15% of the revenue, but they want to actually go ahead and expand in the Indian markets. Also, the existing markets where they have presence outside India, they would want more products to come in, deeper penetration apart from it. Thirdly is that they want to extend relationship with OEMs. Caterpillar is one of the big suppliers, so they want to actually do more business with the existing OEMs rather than find new clients, which is becoming tough for them. They want to expand the product range. Anyway, they are into off-highway tires, and that is something that it's a very tedious product. It's a very niche product, so they want to actually come out with better products also here, and they want to take an advantage from the shift from bias to radial tires, and they've already started doing that. So these are the things that they say that they will adopt, but overall the environment looks challenging according to them global, and if 85% of the revenue comes in from the export market and they're giving signs that it is cautious there, that's a sign of worry. Just in terms of valuation, one of the most expensive tire companies, no doubt the margins that they clock are much superior than the others, but currently on an FY19 basis, it's trading at, it's one of the most expensive tire companies.
It should be interesting, actually, before I take the next question to Darshan, just bring the YTD performance of all the tire makers. Balkrishna is one, but SEAT and the others, because the others have been under pressure. SEAT, barring the small uptick that we've seen in the recent past, it's come off, as has Balkrishna, of course, but SEAT has come off quite rapidly from the highs that it was trading at to the levels that it is, probably at trading at YTD lows. They also have some export, SEAT does, as do maybe one or two others. Now, if Balkrishna is finding this market challenging due to trade barriers, I can understand the product is niche, but if trade barriers impact OTR tires, they would probably also impact the normal tires as well. There could be pressures on the others too.
It could. Apollo has a sizable export. That is something I'm sure of. I'm not sure of MRF and SEAT.
Yeah, SEAT has a small exposure.
They may have, but I think the maximum of effect will come in on Balkrishna Industries, because 85% is from there, and most of the tire companies have seen a lot of problems. So you look at the price of, and we were just doing a comparison. SEAT was down, Balkrishna was down 3% on a 12-month basis. Yeah. SEAT was down 35%. So Balkrishna in a way has been outperforming the tire peers, but despite having much superior valuations.
Well, it'll be interesting. Darshan, SEAT has just inked a pact with Tamil Nadu government a week or 2 weeks ago for a 4,000 crore greenfield tire unit, some of it which will be used for exports as well. If these pressures continue, I hope not, for the next few years, you never know what could happen there. But thanks for putting this into perspective. That's one of the best performing tire companies now starting to sound a bit cautious on its key market, or the key segment, which is the export segment, because of the trade war fears that are going on right now. Well, that's all that we have on First Word today, though. But lots more lined up. On IndianOpen, we discuss Federal Bank's June quarter earnings with Managing Director Shyam Srinivasan. Discuss Future Lifestyle's investment in online retailer Koovs and the impact ahead with Rakesh Biyani. But all of that is a bit later on. For now, we take a break, a full tilt towards the day's trade after this very quick break. Stay tuned to Bloomberg Edge Live.
This is a show which gets you a complete wrap of all the stocks that are buzzing in trade.
Everyone's a price taker, not a price maker out here.
There are better opportunities in the marketplace.
The return ratios will improve, margins will improve. What are you seeing? Valuations are extremely expensive.
It would take 100 years of profits to really pay off the entire debt.
Not all good businesses are good investments.
Good return on equity could be expected.
And I think that is sustained.
Their numbers, etc., were pretty sluggish.
How much longer they can sustain, I'm not too sure.
It has never been the scenario in any of the stocks.
It's an avoid for him at this point of time.
I wouldn't write it off in such a hurry.
We are getting into more complex chemistry.
Join me as I navigate the hottest stocks and help you pick the right stock at the right time. Welcome back. You're watching Indian Open. Let's see how the Asian markets are faring at this point of time. Most of the Asian markets are doing well in trade. Nikkei is up almost 1%. The Shanghai markets are up 0.3%, and the Hong Kong markets are up almost 0.3%. The SGX Nifty is indicating a big up move at this point of time. The SGX Nifty is indicating a gap up opening of almost 38 points at this point of time. So we will be comfortably trading above the 11,000 mark in trade after the big move that came in trade yesterday. But let's also take a look at all what's happening in the derivative space. And Agam is standing by. Agam, good day of trade yesterday. What are the cues indicating now?
Well, Darshan, we're starting to see a lot of traction in the options and around the higher levels, and I'm going to talk about that. But the positive here is that we're starting to see accumulation towards longs when it comes to the Nifty futures. The same for the Nifty bank futures as well, where we've seen an addition of around 3.5% in open interest, even as the underlying advances by as much as well over 1.2%. That said, let's take a look at some of the other key variables as we move into trade today. And when it comes to the open interest, as I was suggesting over the previous couple of days, this open interest, maximum open interest in the put side of things has actually moved from 10,600 to now 10,800, and this is what I was talking about when I say a shift in the upper levels. And while 11,000 call continues to maintain the maximum open interest, we're starting to see some traction around the 11,100 and 200 calls as well, and which some may argue that that's where we're starting to see some amount of resistance on the upside. That said, at least in yesterday's day of trade, we did see a lot of unwinding in the 11,000 call, as in a lot of more writing in the 11,000 put. But let's move on and talk about the other variables which will also be in focus for the Nifty put call ratio. The PCR went up to around 1.68. The Nifty banking PCR also moved up higher. And in terms of some stocks, Adani Enterprises and Adani Power entered into the F&O ban, joining Jet Airways, which already is in the F&O ban. Among few stocks that I'm watching out for, Mindtree. We saw some longs accumulate. Do remember the company announces its earnings today, post-market hours. It'll be interesting to watch how a lot of these traders will take their positions in Mindtree as we move into that event. That said, PC Jeweler continues to grind lower. We've seen a hit of another near 7%. Open interest increased by another 8% as well. And finally, the stock on my radar is DCB Bank. This one's an interesting one because we're actually starting to see some short covering, considering it ended the day marginally higher, but open interest declined by as much as 11%. So a lot of stocks out there to keep an eye on. And of course, as per the suggestions of the SGX Nifty, let's just wait and watch as to where the Nifty as well ends in today's day of trade.
Okay, many thanks for that, Agam. And one stock that we'll certainly watch out will be Zee Entertainment, because they reported their numbers post market hours yesterday. A healthy ad revenue growth contributed to the surge in the company's top line. Saloni Dhanuka is here to sum up all the key takeaways from the quarter gone by. Saloni, what did you make of the numbers? How do they stack up? And any key important takeaways from the management commentary?
So Darshan, Zee Entertainment reported in-line set of numbers. Well, talking about few headline numbers, revenue grew by nearly 15%, while the net profit increased by over 30%. Now, this was on the back of lower tax incidents that were seen in the base quarter. While EBITDA was up 17%, their margins expanded by a marginal 50 basis point, and it stands around 31.9% for the quarter went by. Now, overall ad revenues were above estimate, but subscription on the other hand was slightly below estimate. Now ad revenues grew by 19% on a YOY basis, largely on the back of higher ad spends that we have seen from the FMCG players, and also due to increase in Zee's network viewership share. On the contrary, subscription revenue grew at an 8% rate YOY versus our estimate of 12%. Now this was due to a decline in subscribers in their international business. That apart, despite a downtick in subscription, management still remains confident to add subscribers in quarter 2 largely on the back of the strong content pipeline for their digital platform that they are working with, that is ZEE5. Now, they have already released 14 original programs on their ZEE5 app, and they plan to launch another 20 such original programs in the second quarter of financial year 2019. While their digital initiatives have already started yielding returns, and ZEE5 now stands among the top 5 entertainment platforms in India. So on an overall basis, numbers seem to be in line with our estimates. So we may see a flat to positive reaction for Zee Entertainment.
Okay, so we'll watch out for Zee Entertainment. Let's get in a guest now. Pankaj Pandey, Head of Research at ICICI Direct, joins us on the show. Good morning, Pankaj. The big reaction will come in on Zee after the numbers that came out after market hours. Any view? How did you all find the numbers?
Hi, good morning, Neeraj. I think the numbers were in line with our estimates, and I think the highlight is that the company is going to grow better than the industry average. And I think if somebody, we look at from the FMCG sector point of view, which is one of the top ad spenders, I think the outlook for some of the companies which have come out have been quite positive. So it is we would expect that the ad spend by leading FMCG companies would remain intact. In fact, it is expected to be better, irrespective of the fact that you might see some bit of a margin pressure for some of these companies. But I think with higher ad spend, the outlook for Zee Entertainment looks pretty strong. So, and with better numbers and overall, I think the numbers have been fine, and we will continue to maintain our positive stance, though we have not released the report as of yet.
Interesting. Pankaj, good morning. Neeraj here. What about the PSU banks? This fund infusion that has come in to enable them to make the coupon payments, does it materially alter the landscape, or will this be a short-lived rally?
I think, Neeraj, structurally, if you look at banks need capital at regular intervals, and if the provider of that capital is going to be government, which is what has been the case of PSUs, you might see a short-term movement in the stock. But structurally, I think the performance needs to improve on various fronts for PSUs to attract capital from various investors. I think that will be a key challenge for most of the PSU banks. But there are some PSUs which stand out, or where we don't see much of a challenge in terms of raising capital. And these are the banks which is what we like. So primary among them is State Bank of India, you have Bank of Baroda, and the Indian Bank in particular. So I think these banks really do not, we would not expect them to face challenges in terms of raising capital. I think the rest of the pack, we would not expect any meaningful performance or outperformance relative to the market.
Would BOB also fall in that list? I mean, I appreciate the fact that it's one of the largest PSU banks, but, you know, I mean, just looking at the other factors, don't think PS Jayakumar is even looking for an extension. And it almost seems like the man who was thought to be the knight in the shining armor and will change the fortunes of BOB is kind of saying that this is beyond me. Let me not dwell into this. Could it be a long road to recovery, Pankaj? I mean, and conversely, would you be happy taking a bet on Bank of Baroda at these valuations?
So like I said, there are three banks which will primarily dabble with, you have SBI, then you have Bank of Baroda and Indian Bank. So even Bank of Baroda, I think relatively we find this bank to be better than the rest of the PSUs. I think we'll continue to I think beyond that, you really do not have much to look at in terms of PSUs. Short term, there could be some positivity because if the crude actually declines, there would be a prospect of lesser rate hikes domestically, and again, GSEC yields could cool off, and that might lend some positivity. But structurally, I think beyond these three banks, one should not be really chasing beyond this universe.
Pankaj, what about a company like Ashok Leyland? I think two news impacting it. First of all, the numbers that came out yesterday. Firstly, want your opinion on the numbers, and secondly, this increased in axle that the government allowed, and they have said it's also applicable for older vehicles. Do you think that would play a big hindrance to growth of commercial vehicles?
So largely, so from a number perspective, I think the numbers were largely in line with our expectation, including the EBITDA margins of double digits. We would expect that for the next 2 years, the outlook for CV remains pretty strong. I think the challenge or a shorter term challenge for the company is coming from the fact that there's discounting which is still going on by a leading player like Tata Motors, and which is sort of impacting the realization. And that challenge aside, I think the actual increase I think would not have that kind of a material impact because a lot of overloading was usually happening. So it is just merely legalizing of that overloading. But in case if there is an impact on the secondary market, I think that we'll have to see. Possibly we might get some clues from the management today. But I think overall for the CV, we expect a good volume growth for the next 2 years. And if the government comes up with the scrappage policy, I think the outlook beyond even 2020 also would look better. And we have seen a good amount of correction in Ashok Leyland. I think the company has structurally been looking to become more capital efficient compared to its historical past. So I think because of which one should remain positive on Ashok Leyland.
Okay, Pankaj, just hold on. Our research team is now waiting by with all the stocks that you need to watch out for. So Shraddha will be telling us which are the important stocks in her list. Then Nikki will tell us about all the important earnings that came out after market hours yesterday. And finally, a very important note, an interesting note by HSBC on L&T Infotech in which they have initiated on the counter. So let's start with you, Shraddha. Which are the important stocks that are on your list today?
There's not too many non-earnings linked stocks, but HDFC Bank is something that I would watch out for. HDFC Limited, that's a parent company, has invested 8,500 crores in the company via preferential issue, which was allotted at the price of 2,174 per share. This, of course, is a part of their earlier announced plans to infuse funds in the bank to maintain their shareholding. PNC Infotech will be in focus as well. They've bagged orders worth about 1,150 crores. Kridan Infra is another one where their JV has won about 220 crores of order for highway project. And you also have Volta India, which has signed a pact to implement revised restructuring of bonds. So we could probably see some reaction there as well.
Okay, so we'll watch out for some of these counters, but in the midst of the earnings season, and Nikki, which are the important stocks that came out with earnings after market hours?
Sure, Darshan. I'm going to start off with Jindal Stainless. Good set of numbers reported by the company on year-on-year basis. We're looking at a 56% uptick in the top line number to a number of around 3,147 odd crore. Profitability, PAT has more than doubled to 91 odd crore, and EBITDA has shot up 50% for this company's. Margins, however, remain flattish around that 12% kind of level. Importantly, the company has become eligible to exit from the CDR scheme, and the consortium of lenders have also recommended the same. However, the matter is yet to be taken up for approval in the CDR forum. Next in the list, we have Tata Sponge Iron, which has also reported good set of numbers. Sequentially, however, due to the lean period that we have, it's a flattish growth on revenue and the EBITDA front. But on YOY, numbers look great. Revenue up 50%. Bottom line too is up by 50%. EBITDA, we're looking at a 55% uptick. Margins remain flat at 23%. Rallis India, again, good set of numbers reported by the company. But then let's bear in mind the fact that the base quarter of this company was relatively weaker due to a disturbance witnessed in the stocking patterns at the channel level. On year-on-year basis, revenue is up by 30% for this counter, profit up by 20%. Similar is the case with the EBITDA. Margins remain somehow flattish around that 14 to 15% kind of level. The last company that we have in our list is Syntex Industries. Domestically, the quarter under review has been a reasonably good one. We've seen a good performance creeping in from the home textile majors, which has been boosted by the demand of yarn. Revenue up by 34%, profitability up by 11%, and margins remain flattish around that 11% level.
Okay, so we'll watch out for all these companies in trade today. And Agam, an interesting note by HSBC on L&T Infotech. So what's the rationale for their target price?
Well, they're actually very positive. They initiated a buy with a price target of around 2,100, and the rationale here is a strong brand able ability to penetrate large deals and accounts, as well as they do have support from strong growth, and on account of that they are actually factoring in a well over 15% CAGR, which is higher than the industry over the period of FY18 through FY21. Do remember that they do expect margins to expand by as much as 250 basis points, not only on the back of the depreciation on the Indian rupee, but also operational efficiencies, and they're largely positive when it comes to their organic growth, and that is one reason why HSBC suggests is why they command higher valuation, and that's the reason why they put in a price target around 2100 rupees per share.
Okay, so we'll watch out for all these counters in trade. Pankaj, we're in the midst of earnings season. The biggest cement company, UltraTech, will come out with its numbers today. Anything interesting that you're watching out that the management would say, or anything in the numbers that you're expecting?
So on UltraTech, Darshan, we are expecting overall volume growth of about 28%. That is inclusive of the JP numbers. Now, if I sort of exclude that, the organic volume growth would be about 5%. I think for entire cement as a play, because of higher freight cost and higher petcoke prices, what we have seen is that the overall profitability is expected to decline, and same would happen with UltraTech also. So we are expecting about 22% decline in profitability. I think the key thing to watch out would be the kind of prices. If there is a relatively improvement in prices on a pan-India basis, I think that is where the key commentary needs to be, or the management commentary needs to be watched for. Otherwise, I think utilization levels in the industry is quite fine. So as and when the realization starts catching up, we would see price performance from this sector. Otherwise, what we have seen largely is that this sector has been a non-performer in the past few months.
Pankaj, what did you make of some of the results that have come out thus far? Yesterday's list, the metal companies, Jindal Stainless as well as Tata Sponge, the numbers look reasonably okay. Do you like any of these two companies?
So Neeraj, we don't have a view on both the companies, but on Rallis we do have a coverage, and I think what we've seen in terms of results is that this is one of the best results the company has delivered. Now, there was a fear that because of muted sowing activity, all these companies in the value chain will get impacted. So from that perspective, the numbers for Rallis is quite a big relief for us. And hopefully, with the kind of price decline what we have seen, we would expect a bounce back in the stock to happen. Not to say that everything has sort of turned around, but definitely the numbers are far more positive than what we anticipated.
Interesting. Okay. So Rallis, do watch out for this one. I think companies in this pocket have had a choppy and curvy last few quarters, or last couple of quarters at least. Let's wait and watch if Rallis does react positively to its numbers. Pankaj certainly seems to be liking that. Just looking at the list of stocks which have been hitting new highs, Pankaj Pandey, the FMCG names right up there. HUL may have had a corrective move yesterday, but by and large doing okay. But I'm not really talking about HUL. It's the others, the likes of Britannia, the likes of Nestle, the likes of P&G, which has also nudged fresh highs in trade yesterday, up another 3.5% at 10,452. Do you guys have coverage on the MNC FMCG names?
So we have coverage on some of the companies, not on P&G and Britannia, but overall I think what we are looking for FMCG as the entire play is that about 13% kind of a top line growth and 19% kind of a bottom line growth for the entire pack. And of that, we expect most of the companies to post a double-digit volume growth, which is a good positive surprise. And I think on a valuation side, most of the companies look expensive and very difficult to sort of justify at current multiples. But I think if there is a risk in the market overall, so somewhere down the line, it's a good island of comfort for anybody to sort of look for money preservation, and plus slight capital appreciation. I think what is interesting, which has sort of come out from HUL numbers, is that besides good volume growth, the company has been sort of spending good on ad spend, and so which is why the the expectation of maintaining margin is also remains fairly high. So it's not a one quarter phenomena. So which is why I think we would expect that the entire FMCG pack to keep doing well. Structurally, we are very positive on food companies because that is one space which is where we believe that globally this space has been big, and in India also food companies or companies which have a higher food template should benefit the maximum from the structural improvement in the economy which happens, and along with some of the other fact, if more women join the workforce, structurally these are very positive trends for the food companies.
Okay, hold on, Pankaj. Time to welcome our technical analyst now. Gaurav Bissa of LKP Security joins us on the show, and so does Chandan Taparia of Motilal Oswal Security. Good morning to both of you. Gaurav, first to you. How does the trade setup look to you? Anything on the Nifty or the Bank Nifty?
Good morning. We have been quite vocal about that there can be a bounce back that can be seen towards the level of 11,050. We have seen almost those levels on the verge of getting tested. Nifty has seen a beautiful pattern, also the Bank Nifty, where we have seen the breakout levels were retested, and from those levels we have seen bounce back coming in, fresh longs getting built. There is a possibility Nifty again is on the verge of or on the path to touch the previous high levels of 11,150, 200. Having said that, it will not happen in a week or so. There's going to be some time correction that can be expected. Nifty is a buy on declines market for it, at least in a time being. For today or for next few days, I think selling a triangle, selling a 11,150 call and 10,050 put option or the combined premium 52, I think that is more feasible, for the reason that if you look at the option chain, we are not seeing the kind of aggression. Yes, there have been some selling in the put options, but that is at 10,900, 10,800, 10,700. Now, this does not generally show that market participants are very, very aggressive on Nifty. Otherwise, you would have seen a lot of writing happening in 11,000 put option as well. There's not much of a covering happening in the further stress in the option chain, so call option chain. There's a possibility that Nifty might again have a yo-yo kind of movement coming in, where the supports will be seen at 10,900 and at 11,050 we'll see some amount of corrections coming in. So I think selling a triangle would make more sense.
Okay, and Chandan, what's your view of the trade setup currently? Any calls on the Nifty or the Bank Nifty?
Yes, good morning. After the decline of last two trading session, market exactly retested the previous breakout zone of 10,929. And interestingly, 10,929 was a major level made on the 15 May event day Karnataka election day high. So it has surpassed that, retested there, and now turning higher, which indicates that market may start the next leg of rally. On positional basis, till it holds about 10,929, we are expecting it to rally to us new lifetime high of 11,171. But on immediate basis, one can continue to be with long position by putting stop loss near to 10,950 and can see an up move to us 11,080 and 11,100 kind of zone. Looking at the option data, we have seen a surge in the put call ratio that is hovering at historical highs levels. Volatility index India VIX is trading below 12.5 and comfortably holding below 13.5 zone. So overall rising put call ratio with falling volatility indicates the bullish bias of the market, and that's why every small decline is being bought in the market. Looking at the option concentration, we have seen fresh put writing at immediate strike, including all the strike of 10,800 to 11,000, and call unwinding is seen at 11,000 and the fresh writing is shifting at 11,200. Maximum put OI is shifted from 10,600 to 10,800. So clearly the support is shifting higher in the market. So this entire setup indicates that positive bias or positive to range bound move would continue to be in the market, and further unwinding 11,000 call may give the momentum to us 11,171, 11,200 kind of level. So looking at the entire scenario on positional basis, till it holds about 10,929, we are expecting market to head towards the new lifetime high territory.
Okay. So in light of this, what are the stock recommendations for the day? Gaurav, let me come to you first. Your ideas for the morning?
The first recommendation would be on Tata Chemical. We have seen a lot of short positions getting built. It has been trading on a weak note. It's broken major support levels. However, we are now seeing some abandonment happening as far as the short positions are concerned. I'm anticipating a short covering rally coming in Tata Chemical. There is a gap above 685, 686 zone, which can be filled towards the level of 700, 705. That can be the target. One can have a stop of 680 buy Tata Chemical futures. Second would be buy on Cummins. Again, this is another candidate where we can expect some of short covering coming in. It has seen a significant correction in last couple of weeks, and now it's on the verge of forming a short-term base formation. Again, I am not talking of reversal, but an immediate base is what I'm anticipating. Similar to what Tata Chemical has, it also has a gap that can be filled above levels of 630. Yesterday also we saw some short covering coming in. One can play for targets of 640, 645 and have a stop of 620, 622. I think both of these names can give decent returns in a day or two.
Okay, so those are the calls that coming in from Gaurav, Bissa, buy on a Tata Chemicals and a Cummins India. So, and Chandan, what about stock-specific calls? Which are the stocks that you're recommending?
What we believe that momentum could continue in selective heavyweights counter, and even these selective counters on heavyweight side could cheer the Nifty to take it out for the further momentum. So rather than going for the bottom fishing, I'll continue to be with the counter where strength are holding and these heavyweights are continuously making positive price pattern. So looking at the same, we have positive view on the selective private bank counter, few autos and few heavyweights stocks. First it is buy on Maruti. After the consolidation of last 4 to 5 trading session, the stock is all set to give the fresh breakout. Couple of days back, it has given a breakout from its falling channel. It has surpassed its major supply trend line on daily and weekly scale. It is now forming a small pollen flake pattern, and a small follow-up could lead to the fresh breakout. So recommending to buy on Maruti with a stop loss of 92.50 and expecting it to move towards 96.50 kind of level. Second trade is buy on Asian Paint. This stock is continuously making higher top, higher bottom formation, and after the consolidation of last 4-5 trading session, it is all set to give the fresh breakout. It is given the highest daily close and supports are gradually shifting higher. Here is also we have seen the formation of pollen flake pattern, and this pattern provides a better risk reward ratio and the momentum into the counter. So recommending to go long on Asian Paint also with a stop loss of 13.50 and expecting it to rally towards 14.10, 14.15 kind of levels.
Okay, we'll watch out for counters like Asian Paints as well as Maruti, which Chandan has recommended. But on to our special segment, Bloomberg Edge, where Jayesh Kilani tells us about a pattern that the Bloomberg terminal has thrown up on any stock. Jayesh, which is the stock that the Bloomberg terminal has thrown up today?
Morning, Darshan. It's Tata Global Beverages and the Bollinger Band has in fact suggested long position can be taken on Tata Global. That is because, you have to understand that the stock is still down about 20-21% for the year so far, and there is an outside-inside formation as per the Bollinger Band chart that we have. Let's first have a look at what conditions you have to watch out for when looking at the Bollinger Band and what is the outside-inside formation as well. First, the Bollinger Band, which shows you the expected trading range based on the volatility. It's a very popular indicator that traders use. It plots 3 lines, which is the upper band, the lower band, and an average line that we have. Now, the conditions that you have to watch out for is when the bands expand, it is said to be in a trending market, and when the bands contract, it is said to be in a contracting or a sideways market. Now, when you look at the outside-inside formation that I was referring to, you have to watch out for the 2 most recent candles. So what has to happen is there has to be one candle which has closed outside the band of either the upper band or the lower band, and the immediate next candle or the latest candle that has to come back within the range. So that's how you look at the outside-inside formation on the Bollinger Band as well. Now let's have a look at the chart. That's the last 6-month chart that we have for, or rather the 3-month chart for Tata Global Beverages. What I'm referring to is the last 2 candles over here. You can see that there is a red candle over here which closed below the yellow line, which is the lower band of Bollinger. And you have the immediate next candle, which is the green one, and that has in fact come back within the range. So this is the outside and the inside formation on the Bollinger Band, which means that there could be a potential buy signal going ahead.
And Jayesh, how does this outside-inside indicator or pattern formation work for Tata Global Beverages? What about the history?
So Neeraj, thrice in the last 1 year, there have been such instances, and each trade has resulted in about 5.6 to 5.7% upside for each of the trades over the next 20 days.
Without exception.
Without exception.
Wow, that's interesting. Jayesh, thanks for putting this, thanks for bringing us this update. Now, Gaurav, Bissa, if I can come to you, the terminal is saying that as per the charts, it looks interesting. What about the F&O indicators? How does the build-up or anything otherwise, if at all, indicate a trade on Tata Global Beverages?
Well, for one, we had also recommended Tata Global yesterday to our clients, and if you look at the futures data, we have seen about 6% open risk getting built up. So at lower levels, there's some long cushion that's seen getting built. We have already seen a correction from levels of 290 to levels of 240 to 45, and at lower levels, we are seeing support building up and futures are getting added. It's a good sign. If the current levels of 245, 248, if these levels are held, because these were the breakout levels, then we can expect some up move rally towards level of 260. That would be the immediate target, and it can be seen in a matter of 2 or 3 days. So I think yes, this can be bought at the current prices. One can have a stop loss of 243, 244, and buy Tata Global.
Okay, Gaurav, any view on Nestle? Yesterday, it's at record high, slowly and steadily. It's crossed the market cap of 1 lakh crore. Sentimental impact, no doubt. But what are the F&O cues and the technical cues throwing up on Nestle now?
When we talk about Nestle, it's more prudent to talk of the technical terms because there's hardly any interest as far as the futures segment is concerned. We might see spike of a few hundred portions getting built in the futures segment, but that would not be the right way to read it because the futures as such are not very liquid. And yes, it has given a technical breakout. It can move another 3-4% from the current prices, but I would use any decline in the name to build fresh long portions or to buy again. 10,300, 10,280. These are the levels where I think one can build fresh long portions. One can have a stop of 10,050, 10,100. On the upside, targets of 10,700 can be seen. So yes, it has given a breakout. But I think there are better opportunities. I would rather play for the stocks that are on the verge of a breakout because that will give you more probability of making money. It is a safe counter. It can move another 2 or 3 percentage points. But the risk reward at these levels, it's not in the favor. The risk reward would be at least 1:1. And I think buying a future with risk reward of just 1:1 would not make much of a sense.
Pankaj Pandey, now since banks are the focus, I want to come back to you. Do you guys have coverage on Federal Bank? And if so, what did you make of the numbers and the move that we've already seen on the stock?
So largely against the backdrop of higher slippages, I think the numbers were quite positive surprise in terms of lower slippages. And what we have seen is a very good growth in terms of NI and bottom line growth. And with lower slippages, the expectation or the probability of the growth being maintained is fairly high, and which is why I think we have a buy on the stock, and it's trading at about 1.6 times, so it's not that expensive relative to some of the tier 1 players. But within regional banks, we like the CUB more because it has been a very steady performance by City Union Bank. But I think Federal Bank with lower slippages and improving growth prospects or sustainable growth prospects of over the next few years, I think the stock would have further room to sort of grow. We had seen a good amount of decline already in the stock, and it's like I said, trading at about 1.6 times. So from that perspective, it's a good buy even at current levels.
Interesting. Okay, so Federal Bank. The other is this fall in crude and a resultant move that we've seen on almost all of the oil and gas names yesterday, Pankaj. Would you have a call on any of the oil marketing companies, any of these three, or conversely even stocks like MRPL, which showed a big uptick yesterday?
So Neeraj, I think the biggest challenge in taking a call on oil marketing companies is one has to eventually take a call on crude oil prices. Now we still don't know whether what kind of cornering US is going to do of Iran, which is a big supplier, and eventually the oil prices can swing in both the directions. But what we have seen is that gas as a space is relatively far more better, and what we have seen also is that the city gas distribution companies make a good case on a structural basis, given the fact that the gas penetration overall is far more lesser. It's a cleaner fuel. So even the government will take more or will take efforts to sort of promote gas, and which is what we have seen in the recent auctions for city gas distribution. So I think both IGL especially and MGL look attractive to us. I think that is the way, space one should be into. rather than sort of taking a call on upstream or downstream companies.
Pankaj, among the mid caps, which are the stocks that you're recommending to clients? Most of the counters have come off significantly. Any stocks where you're finding value now?
So, for example, we like graphite or both the graphite manufacturers. So, Graphite India specifically we like more. We expect a very good set of numbers for the company. So, mind you, if you look at in 17, this company earned a profit of about 70 odd crore, and in 18 that jumped to about 1000 odd crores. In this particular quarter, we are expecting the company to post a profit about 662 odd crores. And we are fairly confident in terms of realizations being sustained, and with these kind of realization and with this kind of a profitability, the company is still available in single-digit PE multiples. And mind you, the company does not have any debt on the book. It'll have a good amount of cash in the books. So from that perspective, we have seen a good run up in the stock. We still like the stock. This has been part of one of our portfolios as well.
Okay. We'll watch out for this one as well. Pankaj, stay on. Some more questions really, but the pre-open rate's about to kick in, and expect a start in the green. If the Asian screen or the SGX Nifty is to be believed, we'll have a good start and we'll take off from where we left off yesterday. Remember, yesterday India was a bit of a solitary performer, but all over the place right now. Let's wait for the benchmark rates to stabilize a bit before we talk about them. Zee Entertainment should come up amongst the stock in news, and let's see what that one is doing as a result reaction. Well, a couple of percentage points higher. Let's wait and watch if this lasts or no. No big positive surprises, but the numbers largely in line with estimates. At least that's what I could make of what Saloni mentioned. Let's see if there's some further move in store or no. BP, HP, IOC amongst the top performers in trade yesterday. Let's see what these are doing in the session today, how they're starting off. Well, marginally in the green for each of these. Actually, let me even throw in an ICICI Bank there. Did reasonably well in trade yesterday, ICICI Bank, after some time. But no, short-lived. Again, might change really. Last but not the least, Federal Bank, big mover in trade yesterday. Let's see if that one has some further moves in the pre-open itself. Looks like starting off on a steady note. Keep in mind a programming note for all those who want to know what Federal Bank's future is likely to be. Shyam Srinivasan Johnson at 9:30 to talk about his quarter and the outlook ahead. So do stay tuned in for that as well. Darshan, what are you spotting?
Yeah, so on the mid-cap end of the market, Tata Sponge is up 20%. Numbers came out after market hours yesterday. Pretty strong set of numbers. Now has corrected. Now is down just 6%, but nevertheless will have a positive opening. I'm really surprised seeing the moves on Corporation Bank, which is showing an uptick of 19%. IOB is again showing an uptick of 19%. Probably will change in trade. PNB is showing an uptick of 10% currently. So PSU Bank, certainly there seems to be traction on the positive side. 8K Miles came out with its consolidated financial results for the full year. They haven't still come out with the first quarter number yet, but 8K Miles is up almost 10% in trade. Look at the PSU banks. Andhra Bank is showing an uptick of 7%. The other banking name is NBFC name is Magma FinCorp, which is showing an uptrend currently. So watch out for PSU banks today. Most of the PSU banks are doing extremely well in trade currently. What is not doing well? Quality, Vakarangi, PC Jewelers, Varun Beverages. So that's the name that shows up. Infosys is starting out with a negative bias, but I really want to pull out names of the companies that came out with numbers yesterday after market hours. So let's pull them up. So one of them was Zee. Neeraj already pointed out, but let's see how the traction has fared out. It's up 3.5%. Rallis came out with strong set of numbers, so let's see what Rallis is doing. It's up 2%. Syntex Industries, the number were decent. So Syntex Industries, if we can pull that up, that is showing an uptick of 19%. So this is Syntex Industries, is the textile unit. Plastics was really disappointing yesterday. Jindal Stainless and Tata Sponge were the other two counters I want to pull up. So let's see how they have. Jindal Stainless starts on the positive bias, and Tata Sponge was up 20% at one point of time, has managed to cool off to just 2%. And the other two numbers which were decent, not bad numbers, was Nucleus Software and CRISIL. Pretty much in line, steady growth, nothing exceptional. So Nucleus starts up 2.5%, and CRISIL is starting up 1%. So strong traction to the result reactions that have come in. Most of the numbers have been decent as the first quarter numbers are concerned. Very few companies which managed to disappoint. The trend at least seems on the positive side.
Well, Monday onwards, Darshan, we'll start looking forward to the earnings heat map that you used to bring, and we might have a lot more companies for Darshan to be able to bring that out for us. But yeah, good reaction. It's a big day for mid-cap IT too, by the way. Remember, 3 or 4 numbers come out today. Just a quick check on the currency and the bond yields as well. I believe 68.39 or thereabouts would be where the rupee is, 68.43, so flat as flat can be. The bond yields too should come up on your screen, about 7.72. There's been a remarkable drop down in the bond yields from 7.9 a few days back, maybe 10 days back, to about 7.72, which is quite interesting. It's happened. Okay, initial thoughts from our experts first. Chandan, Taparia, to you. Looks like stocks like HDFC and Zee would be the ones which will pilot the up move. At least they look like starting off on a good note. What do the positions in, say, the HDFC suggest?
Yes, we are positive on the HDFC Bank Limited. Both longs are intact. Some short covering was seen yesterday also. Both the stocks are trading at their lifetime high territory. HDFC Limited is all set to head towards the 2000, 2010 kind of level. Similarly, HDFC Bank looking for 2200 to 2225 kind of level. So a put writing is clearly visible and the momentum could extend for both the counter. Even for intraday and for a couple of days back, one can continue to be with the long position on HDFC Limited and HDFC Bank. Yes Bank might be the other name in this kitty. Talking about the Zee Entertainment, the stock is bottomed out, but yes, shorts were seen. So some bounce could be seen. And it is important whether it surpasses 530 or not. So as of now, the bounce back of 2.5% could be seen, but after that, one has to look whether it surpassed the major hurdle or not.
Okay, Pankaj, what do you make of certain NBFCs like Bajaj Finance and Bajaj Finserv being taken as safe haven bets, but nevertheless valuations are skyrocketing for those two counters also? Do you see further upsides in these two?
So if you look at for both these companies, we have a coverage on it, and both the companies we have been liking a lot, and these stocks are part of our portfolios as well. I think if you look at top 30 or 40 odd companies, this would be the only company which would be delivering the highest ever growth rate. So even for this particular quarter for Bajaj Finance, we expect NI growth of over 40 odd percent and bottom line growth being 44 odd percent. Now, compared to that, you will find a lot of NBFCs which are cheaper and probably growing at a slower rate. But our sense is that growth is the biggest variable one should look at. And I think this stock has been trading between 4 to 5 times book value for quite some time. And as long as the company is delivering in terms of growth, I don't see a problem for the stock. And for the medium term, we don't see any challenges for this company in terms of not maintaining the kind of growth rate it has delivered. So I am not surprised with these stocks hitting 52 high levels. So we continue to remain positive on both these companies. Structurally also, we prefer companies where the growth rate is far more better. So for example, if TCS is delivering far more better growth, we would prefer TCS compared to Infosys, because Infosys is yet to sort of come out with stronger, or has to still sort of match the numbers with the kind of TCS is delivering, TCS being a bigger company from that perspective. So I think for me the growth is the bigger variable than valuations.
Okay, Gaurav, Bissa, any of the PSU banks stand out for you? Yesterday and today they've had a good move. They've probably cooled off a little bit, but the smaller ones, I mean, I don't know how many of these you track, but an IOB, a Corporation Bank, Andhra Bank, etc., all of them have done reasonably well today and did fairly well yesterday too.
Well, I would only say that PSU banks are good for trading. If somebody wants to have a position view, that can be quite detrimental. We have seen that PSU banks have a tendency to give 5-10% gains, and then again they see significant downside coming in. Today, with the development that we have seen, I think if there's a gap up opening, I would avoid buying PSU banks. Rather, it's a good time to book profits. I would buy only on decline. So whether it's something like Allahabad Bank or OBC, all of these banks are trading near the support level. So any dip in these names can be used for trading opportunity. Again, I would not play either for a positional view or for a reversal at this point in time.
Okay, Pankaj, take a moment to thank you for joining us today and giving us your thoughts. Just a quick perspective on the dairy space now. The joint MD of Prabhat Dairy, Vivek Nirmal, joins in right now on the show to talk about all that's been happening in the space and yesterday's comments from Piyush Goyal about a subsidy for exports. Vivek, good having you. Thanks so much for joining us on Bloomberg Quint. This is Neeraj here. Good morning. What do you make of this small incentive that has been given for exports? Will this make a material impact to companies like yours which might be exporting either milk or dairy products across the world?
Yeah, I think dairy exports from India right now are a necessity, and globally the dairy prices are relatively low. So this incentive is definitely a very good boost that bridges the parity in between the Indian milk prices and the export milk prices. So it is definitely a good move. Apart from this move of central government, a couple of state governments are also extending their incentives. Some of them have been declared, some of them are in pipeline. And I'm sure that is going to be a great boost because it will bridge the parity and it will move a lot of stocks out of the country. This which will further improve the overall sentiment and the milk prices. So because the milk prices right now, if they go further down, they could go to an unsustainable level. So I would definitely say that this is a very good move.
Okay. So a couple of questions out here, Vivek. Yesterday, I think we were speaking to Amul, and I don't know if the quality and the pricing of milk that company A versus company B do on the export market is vitally different. But they had to say that even with this incentive, their pricing, the pricing will not match the kind of pricing that is needed to export, and they would have hope maybe for some more uptakes or some more incentives. Are you saying that the incentive that has been provided thus far, which is about 10 odd rupees, is good enough for the dairy space or maybe for you individually?
Yes, as I said earlier, this incentive combined with the state government incentive, which the government, some of them have been declared, some of them are in pipeline. I think both of this put together will definitely create a good impact.
And would these incentives be given for milk products as well, or is this restricted to just, the pure commodity, which is milk?
No, as of now, I think this is definitely applicable to products as well, not milk only. But obviously, since when the notification is out, it will be, I think, more clear.
Okay. I have one last question, Vivek, and which is on the pricing of milk as well. I just heard you say that if prices drop below a particular level, it will become unsustainable. Oops, I think we've just lost out Vivek Nirmal on the line. But nevertheless, got the sum and substance of the discussion. He seemed to believe that this national incentive, coupled with a couple of state governments also giving the incentive, makes this a sustainable piece for them. Let's see, the dairy companies, Darshan, remember yesterday shot up late trade. In today's session, they're starting off on a flattish note.
Yeah, that's about it. But, the problem, this shot up because of the Piyush Goyal comments, but milk prices still are not inching up. There seems to be agitation, so it'll be interesting to see how they pan up. One stock I'll clearly watch out today will be Dr. Reddy's. What has happened and is that in overnight news, what has happened is that, the counter did manage to correct 10% the day it lost its case to Endeavor. What has happened now is the fact that the US court has asked Endeavor to post a bond, which is turning out to be close to $1.3 million a day till the time his case is not there. And this was known that, Endeavor will have to post a bond, just that the amount was not known. Now this amount is known, and Nomura has come out with a note, and they believe that the bond quantum is large enough to compensate Dr. Reddy's for any kind of lost sale. So probably some bit of relief coming in for Dr. Reddy's at this point of time. So it'll be interesting to see how Dr. Reddy's reacts to trade. Anyways, Pharma as a pack is doing well. Sun Pharma is one of the top gainers in the Nifty. No doubt Lupin is not doing well, but Reddy and Sun are among the Nifty companies which are doing well in today's trade right now.
Okay, so we'll watch out for Dr. Reddy's as well. I would have loved to take an opening call, but I'm told that we also have the chairman at Hatsun Agro with us. Do we have Mr. Chandramogan with us? Okay, we do have. Maybe just one quick initial thought and then we'll do the market open. Mr. Chandramogan, thanks for joining in. Are you happy with the incentives that have been talked about by Minister Piyush Goyal? Would you have hope for this or would you have hope for more?
No, basically probably this is too little too late.
Too little too late. You would have hope for more?
Too late. Actually, the stocks of powder is more than 2 lakh tons, and this incentive is of no use at all to the industry.
Interesting. Somebody else that we spoke to, Mr. Chandramogan, did mention that this national incentive with a couple of state incentives might actually help. Would it be state specific, or do you believe by and large the incentive should have been much higher, and if so, how much?
No. I am not talking about even incentives. See that Problem is these 2 years of gradual accumulation has led to 2 lakh tons.
Right.
2 lakh tons have to move out of the market only through by some grants to SAARC countries or African countries, which will be valued at around 3,000 crores. Unless this is moving out of the country, the prices will not stabilize. Upon giving subsidies to the farmers is not of any help. This has to be balanced out only by sending it as a gift and removing the excess stock from the market, which is already coming close to expiry dates.
Okay.
So the aging stock is stuck with a lot of cooperatives. We have to find a way out for this stock, and this 10% subsidy is nothing. 134 rupees is the present price of New Zealand powder yesterday.
Got it.
If that is the case, the cost of milk powder production here is 180. What do you do with 10% subsidy?
True.
Again, this is on the export price. You have not been in the export market for the last 2 years, and if you get into the market, you have to give a discount
Competitive
of 10%.
price. That's true.
125 entry price, and if you are going to get into 125 still with the subsidy, you will be longering around 130, 134. That is not going to really help.
That's fair. That's fair. Mr. Chandramogan, this requires probably an extended discussion. I would request you, the equity markets are opening right now. I would request a reconnection with you at some point of time in the day to understand this in detail so that we can send out the correct message to the powers to be as well. But thanks so much for this initial update, sir.
Thank you. Thank you, sir.
Well, that's the chairman at Hatsun Agro. Just 20 seconds left for the markets to kickstart trade. Maybe just take one quick thought or one quick pick from, let's say, Chandan Taparia. Then we'll go to Gaurav Bissa. Chandan, quickly, your top call for the day.
Yeah, Maruti, looking for positive momentum. This breakout is going to happen. So one can continue to be with long position and can add more.
Okay, Chandan, stay on. Gaurav, request you to stay on for your top call and initial thoughts as well. In a bit, we'll join by Deven, Choksey. But this is how the markets have started off today. About 0.5% up for the Nifty, the Sensex 0.5% too, and the Nifty Bank 0.4%. So a good start to the benchmark indices. The mid caps and the small caps should also come up on your screen. Well, 0.5% apiece for both of these after a 2% uptick in trade yesterday. So the rally continues. And the Nifty is now inched up to about 0.6%. So the going is strong at the start of the trading day today. The heat map should have a lot of green, hardly any red. Darshan will bring up Dr. Reddy specifically, but that stock seems to be at the top of the pile right now. No other big movers. A clutch of stocks moving up about 1% apiece. SBI, HDFC right up there in the mix, and the OMCs too right up there in the mix as well. So good going really out here. Zee Entertainment about 1.5%. So that one too starts off on a very, very good note. Bring up what's happening to individual pockets before I hand it over to Darshan, and I'm sure Dr. Reddy's would be firmly in focus. We need to explain this story once again, I'm sure, but just 2 or 3 pockets of focus at the start of the trading day. Capital infusion and almost all of the PSU banks continue from where they left off yesterday. In fact, IOB at 11% is packing a serious punch for itself. I'm sure Corporation Bank is right up there too. What about the result reactions? What about stocks which did reasonably well in trade yesterday? So good results for JSL, Tata Sponge as well as Rallis, and each of these 3 stocks start off in the green. The market momentum probably helping them as well in trade today. And stocks which did well in trade yesterday, I think we should bring up that list too. Tuesday's gainers. So Hathway, the rally was short-lived, 10% up yesterday, down today. Federal Bank marginally higher, but MRPL is the one which was up about 9% in trade yesterday and now up another 1.5%. Darshan, what are you spotting?
Some of the counters which are in focus currently, among the counters on the mid-cap end, IOB is up 14% in trade currently. 8K Miles, after giving out its consolidated FY18 numbers, is trading up 9% in trade. Positive reaction coming into Jindal Stainless post its numbers that came out, so that is doing well. PNC Infotech won an order in Karnataka, so PNC Infotech starts up strong. JK Tyres will come out with numbers today, but ahead of the numbers is looking strong. And PSU banks like PNB, Allahabad Bank, both of them are rallying in trade. Let's pull up Rallis, came out with strong set of numbers and has managed to inch up in today's trade. As far as some of the losers are concerned, the same names, JBF, Vakrangi and Quality topped the list. Ashok Leyland did manage to rally post the numbers. It managed to cool off at the end of the day, trading with a negative bias post an inline set of numbers that has come out. Some of the other counters, HEG above the 4,000 level. It's trading at record highs, so it's managed to cross the 4,000 level. Nestle, the market cap of over 1 lakh crore. Let's see what's happening there. It'll be interesting to see what's happening. HDFC Bank rallying in trade. It's trading at record highs. So is Berger Paints. Berger Paints is at record highs. And among the Nifty counters, let's pull up. GAIL is trading at days high. Indiabulls Housing Finance is trading at days high. And ONGC has managed to react positively to trade. So that's the setup. I think it's HDFC Bank that's leading the way. It's up almost 1% currently.
Yeah, and PSU banks at the broader end of the spectrum, really. Some really good start for the markets and still holding on to that 0.5% uptake. Deven Choksey will be joining us in moments from now. But Gaurav, Bissa, to you, we couldn't even take your top call. But your opening thoughts on how we've started off today. Is there a trade on the benchmark indices? Couple that up, of course, with one stock that you would want to trade today.
With the indices, I would be a little bit careful. Not that I'm having any doubt that it can move further up, but yes, it's already opened with the gap, and I would like to have some more time. I would not take a trade right away. But if you talk about the stock, I think IDBI is one. We were talking about the PSU bank. This is one name, one of the 6 PSU where we have seen breakout on daily charts. If the levels of 59 are held, I think one can have a stop loss of 57. On the upside, target of 65 can be seen. So this is quite suitable. One can look for IDBI. This is one that we would be focusing for clients as well.
Wow, go long at the current levels on IDBI. We'll talk to Deven Choksey about this bailout as well. But Chandan, Taparia, any thoughts, any trades on the index, or would you be cautious as well at these levels? Couple that up, of course, with one stock that stands out for you 4 minutes into open.
Yes, already we discussed about Maruti and Asian Paint. Will continue to be the same. Nifty per se, I'm waiting for a small dip of 20-30 points. Then again, I'll go with buy on decline strategy in the market. Bank Nifty per se, 27,165 is the major hurdle. On expiry day also, it made the exact high on the same. Couple of months back, the high was the same. So now if it manages to hold above the same, I'm expecting a movement of 100-150 points in the Bank Nifty. So closely watching 27,165 on decisive holding basis for next 5-10 minutes. If that happens, I'll continue to be with long position in the Bank Nifty index.
Great. Gentlemen, Gaurav as well as Chandan, Taparia, many thanks for joining in today and giving us those thoughts. Deven Choksey just joining us moments from now, but Darshan, Dr. Reddy's starting off about 1% higher. Is this the reaction that would have been anticipated?
Probably slightly could react. I think the news is not widely known at this point of time, but the bond news is positive. What I'm reading of the Nomura note is that if Dr. Reddy manages to win this case, and if the bond size is close to over $1 million a day, what they're saying is, see, the problem with Dr. Reddy's was not the fine, it was the lost opportunity. So what Nomura is saying that the fine, if it wins, and the bond that Endeavor will have to pay Dr. Reddy's will be sufficient enough to compensate them for all the losses that they had because they didn't get the product. So that's that's what the reason why Dr. Reddy's probably will react positively to this news.
Okay, 1% higher, maybe more in store as well. Let's see what happens ahead. But special voice, Deven Choksey of KRChoksey Securities joins us on the show. Deven, good morning. Thanks so much for joining in. Apologies for a bit of a delay, but a couple of management interactions on the dairy stocks, and we'll talk about them as well. But Deven, can't not talk about this news about 11,000 crores being put into the 5 PSU banks. I mean, how would you look at it? Would you look at it that in a way that the government will not back down from giving much needed oxygen to these banks as and when needed, and therefore that's a positive? Or that these banks can't do without government support, and therefore they're probably not the best areas for capital allocation?
Yeah, good morning, Neeraj. I think the larger issue out here with the government is that they are trying to create the large size banks like SBI in the PSBs, and that's the reason for which I think this particular transaction of the government of bailing out this bank through LIC. According to me, I think the banking business, if we are looking at, it's quite fragmented in the country today. And one of the reasons for which I think some of the banks are becoming weaker is because of, I think, the lack of balance sheet strength. If you end up creating a balance sheet strength in the banking space, and I think create a large size bank, possibility of managing those banks would be relatively better compared to the smaller and mid-sized banks. So from that perspective, I think the objective is quite applaudable, and I would think that if they succeed with this particular objective, that would be writing a new story as far as Indian banking space is concerned. Well, I would believe that I think LIC as a promoter, a strong promoter as I would like to call it as, have got all the wherewithal and the financial muscle to promote a venture like a bank. And I do believe that I think eventually they would try and give this entire bank a kind of a professional setup from what the public sector bank tag that it is carrying. Should that happen, which would be I think a long oriented objective, at the same time implementation plan, it could be I think at least 2 years before which we will see the actual color of this particular move coming in. If it comes little early because of the accelerated phase I think of implementation of some of the initiatives, it would be more than welcome. But to me I think it sounds I think a good experiment, a good try. In a way I think it should help and set the benchmark. Should they create large size bank and compete with SBI in the PSB space, or maybe create an equivalent or a bigger size, I think that should be one should be looking out for that. Larger projects like infrastructure projects I think do require some of the larger banks, and I think that's where you require to create an institution, and probably I think this is the move that I see it. Not too sure whether investor would make immediately any kind of a money, because I think this is going to be a long run game plan which is for implementation. At least in next 2, 3, 4 quarters I don't see enough amount of headrooms, at least I think for investors. Maybe subsequent to that there may be some kind of possibilities emerging on the balance sheet side. Maybe market sentiment can run little ahead of balance sheet, but I think the balance sheet would probably take at least 4 quarters before which it sees the reflection in the books.
Morning, Deven. Hi, this is Darshan here. Just some news that is coming off Bloomberg from their sources. What they say is that Reliance Industries is looking to raise 40,000 crores in fresh debt this year to expand its consumer business. So how do you make of it? By consumer, I would mean that does it include Jio as well as the retail business? And what's your outlook on their retail business? Is it going to be as large as as large as some as what they did as far as Jio is concerned? Are they extremely bullish on that?
Yeah, Darshan, good morning. Well, I think you are right on the subject of the retail business being expanded. Currently in the retail business, we are seeing very smart front end and the back end strategy which the company has adopted. They have the 7,000 plus stores which are already in operations, and they already have I think the supply chain mechanics which are already created in the back end. Now with this kind of a supply chain mechanics that they have created, probably I think this calls for creating a large front end in form of the marketplace in the digital side, on the e-commerce side, and that's what the company is planning to do. In my viewpoint, I think the e-commerce, if you look at systematically, I think can be split into 2 parts: the B2C part of the e-commerce and B2B part of the e-commerce. B2C part of the e-commerce, the clear examples would be Amazon, Flipkart kind of company, where not much of a money to be made, because I think the larger part of the cost is in the last mile delivery. But on a B2B part of the commerce, where you have the established brands which are required to go on online basis, and if you provide the complete infrastructure to them, including the sourcing and delivering infrastructure, which requires I think as a core strength at the back, if Reliance end up investing money into that, I think they would be writing a new story on that front too. And my sense is that I think they are right now putting money into both these areas, the e-commerce segment in which I think they want to expand, and also plugging this entire e-commerce vertical, as they call it ABCDEFG. I think out of that the e-commerce vertical, which is a commerce C, is getting plugged into the Jio platform, and probably I think that's the game plan that they are right now and they have undertaken. So let's wait and see how it pans out, but I think it could possibly be one of the largest company in the e-commerce space, as I see from the game plan that they have drawn, and probably this money that they are raising is also for that purpose. So let's wait and see I think what is the allocation program, but I think more or less this is the understanding that we are gathering right now.
Interesting. Deven, I mean, aside of what's happened in banks, the other space in focus the last few days have been the dairy companies. Yesterday there was some comment about how there will be an additional subsidy being given for exports as well. Conflicting views coming in from 2 managements who have joined us. Prabhat thought that it was enough, coupled with the state incentives. Hatsun Agro said it was too little, too late. The space has been in the eye of a storm for a while now. Stocks like Prabhat have almost corrected 50% from the recent highs. What are your thoughts here, if you have any views on this space?
Yeah, Neeraj, I think above the macro level views that we carry on this particular subject is basically, I think this is going to be extremely competitive business, because it's an essential commodity, milk and the milk products particularly, and that's where the margins are always going to be under struggle for most of the dairy companies, has also been seen from their current performances. On one side you have got the high offtake items like milk and butter and the cheese, I think, where comparatively the margins are relatively less, whereas ghee and other portfolios, ultimately I think those companies which are having those products like Parag, I think would probably find that I think they are relatively more contributing to the profit of the company. Now this is a challenge because I think the other part of the products, I think they assume the FMCG category of sales and they are perishable in nature. So I think neither they would have the ability to stock these particular products on the shelf beyond certain number of days, nor they would be in a position to command higher margins because of the very nature of the business itself. So to me, I think this particular space is always going to be tight margin operating business, and given a situation like what we are right now experiencing, possibly I think we are likely to see some amount of squeeze continuing, and uncertainty is not good for the business. So that's the reason for which I believe that I think this companies within this sector I think is unlikely to give a good performance. So I must say that Parag kind of company has been making extraordinary effort to come out with the branded portfolios in a very systematic way. But I think it's going to be a long drawn game as far as I think establishing themselves and making money out of it.
Yeah, some bit of a pullback today after the flash move in trade yesterday for almost all of the dairy companies. Somehow I seem to be stuck on Federal Bank, Deven, but the last couple of sessions, yesterday and today's session too, it's done very well on the bourses. What did you make of the numbers and what's the outlook ahead?
Honestly, Neeraj, I think haven't looked at the numbers in detail, so I think won't be able to specifically comment on the number part of it. But I think as I see it, the outlook is relatively, I think, more stable for this bank. I'm not too sure, I think, how they are getting integrated with the other counterparts or the peers. I think that's not something which is my clarity at this point of time. But on the whole, I think looking at the standalone commentary of the company, probably I think they are relatively better off compared to many others in the same space in which they are operating.
Did you have a chance to look at the DCB numbers? That's the other mid-sized bank that was in focus, Deven.
Not really. I think haven't been able to go through it, so will reserve my comment for some other day.
What about the commodity names, Deven? The likes of HEG, Graphite India, or any of the others that you may be tracking? Because while the broader commodity basket seems to be under pressure, there are these select names which, due to specific reasons, continue to do very well.
Yes, I think indeed the HEG and the Graphite India, they are probably in the sweetest of this times as far as I think last 2 decades or 3 decades of their operations are concerned. They have never seen before, I think, this kind of growth in their books and the business, particularly because of the electrographite rods, I think, which are going into the electric arc furnace. They are in typically peculiar demand, and not many companies in the world would have this particular electrographite rods available with them. China has typically moved into a space where they are moving more into the electric arc furnaces and closing down some of the conventional polluting furnaces. So from that point of view, I think the business situation has extraordinarily improved for these companies, and as a result of which we are seeing a very sharp surge in the price that they are seeing. In fact, to my surprise, I think some of the long-term contracts the companies like HEG has signed up, and I think that goes as high as the visibility, I think, for next 5 to 10 years for the supply. I think they have been signing these contracts at a far more better price than what they have commanded in average, I think, in last few years. So from that perspective, I guess I think this particular business is likely to show better performance. Though the raw material costs have gone up, but at the same time, I think the alpha particularly you are getting because of the higher amount of selling price, I think is significantly better. So I would rather think that yes, I think this business has a good story to tell. Unfortunately, maybe for those who want to enter now, I think it's the valuations are expensive. So unless I think you see some kind of a correction for any reason, if at all it happens, that would be the time to look into the space. Maybe I think currently I find little expensive because they have run up little ahead of time, as I would like to summarize and put it across.
Well, thoughts from somebody who's tracked these markets for last 25, 30 years or maybe more. Please take them seriously. Deven, Choksey, many thanks for joining us today and giving us that perspective. That's the view from Deven Choksey of KRChoksey Securities. Need to slip into a very quick break. On the other side of the break, we'll discuss Federal Bank's June quarter earnings with Managing Director Shyam Srinivasan. He joins us. Stay tuned. And of course, also talk to Biyani about future lifestyles investment in few online retailers and the outlook ahead.
Catching up on news feels like a test match. Want the highlights? We hear you.
It's an ocean of news out there. Need a navigator? We hear you.
Do you have analysis paralysis? A case of too much information and not enough time? Do you wish someone would just pick the most relevant topics and tell you what you need to know? We hear you.
Good morning. You're watching Bloomberg Quint. This is First Word.
Curated and presented by Bloomberg Quint's senior-most editors. Weekdays at 8 a.m.
You need a lot of patience into the next industry cycle.
Short-term pains for long-term gains.
Buying is complicated. Selling is 10 times more complicated.
If making money for investors were an art form, these folks would be maestros.
Statistically speaking, there is likely to be a big drawdown sometime in the next 6-12 months.
Is it much more difficult getting stocks right now? I think that is the basic nature of investing.
Equity reflects the future earning potential.
Circle of competence, one of the most important concepts in investing.
Biggest risk that investor takes is when he pays the highest valuation at the highest margins.
Get on a conversation on the art of investing with India's top portfolio managers on Alpha Moguls. Thursdays, only on Bloomberg Quint. Well, thanks for staying with us on IndianOpen on Bloomberg Quint. Shyam Srinivasan, the MD and CEO at Federal Bank, now joins us on the show to talk about how the outlook ahead could be like. What they've done in the quarter is well known now because the market has already rewarded that in trade yesterday. Mr. Srinivasan, good having you. Thank you so much for speaking to us at Bloomberg Quint. This is Neeraj here. Good morning. The question mark at the top of the mind of everybody would be that what you've shown in quarter one, which is a fairly stable quarter, will you be able to show that for the next few quarters? And is it possible to predict that right now, or will you have to take it as it comes?
Neeraj, thank you. And see, as always, the story is never about the growth. It's all around the credit quality. And if you sort of go back many quarters, this quarter was no exception in the operating performance or in the credit growth or the overall fundamentals of the bank. The one big sort of impact was in Q4 of last year when, as you know, the slippages went up materially and consequently the outcomes were less than acceptable. This quarter that got reversed, and I had pointed out that was more a one-off impact of 4 large accounts. And the tail of that, I said, will flow through in FY19. A part of it did in Q1. So I believe that the underlying performance for 10 odd quarters has been 20% plus growth, operating profits sequentially growing as it did this quarter. We are quite hopeful that this momentum will continue. We are seeing us gain share all across, both in credit and deposit across many geographies. So the confidence the bank has in terms of underlying performance remains robust. The credit wrinkles, I think, more or less have been addressed. we don't have any large cases in our portfolio that needs specific sort of resolution from outside of the normal bilateral transactions. So I'm hopeful that we will be on guidance for FY19, and we had, like you probably have noted, we had guided for 65-70 basis points of credit cost, and within the year I said there could be some up and down, but I believe we are on course.
Interesting. So just a couple of follow-ups to that. You believe that the kind of slippages performance that you've shown, I'm just looking at what you did in Q4 versus Q1, and I agree that that was more or less anticipated, but in absolute numbers as well, would you reckon that the trajectory will not show any material tick upwards over the next 3 quarters?
Yeah, we believe it shouldn't be the case, and I've always said that the only wild card in this is Air India, and it's a large account where we are a very small shareholder, share. So we don't know the outcomes, but my personal view is that it won't become a situation where it'll become an NPA. There's some kind of remediation would come into force. So if you keep that 250 crores out, the restructured standard asset book of the bank is about 550 odd crores. So out of that, 250 crores is one account. Baki 300 crores is really a collection of many small accounts, so they don't have any characteristic of falling away in 1 quarter or so. So I would like to believe that outside of Air India, there shouldn't be any giant cases, which we don't have any, which can come to impact us in the course of FY19.
Interesting. Just one small question out here. This is not with regards to Federal Bank alone, but for a lot of banks which have faced headwinds, some of which were beyond their controls, for the last 12 to 18 odd months, we've been hearing these calls of the worst finally seeming to be behind us. Can we safely say, I mean, you've been at this helm, you've nurtured this one Federal Bank now for a really long time now. Do you get a sense that finally the tough times on slippages or NPL formation, wherein there have been a couple of surprises from your end in the past few quarters, are all of these behind us now safely?
I think the one that most bankers, including me, would see is the formation has come down substantially, as all of us have seen through many banks' numbers, including ours. Surprises, I would believe that surprises are invariably from the outside world, never from the institution itself. Some regulation changes, something in the environment, materially changes. So I'd like to believe the formation of new bad has come down substantially. For many banks who haven't grown over the last 2-3 years in credit, the likelihood of new credit slipping is also coming off considerably. And those of us who have grown smartly have grown in the better credit segment. So I am much more hopeful that the recognition has been well done, and I would think whatever tail of it is happening in this quarter or the next because of the impact of the February 12 circular. The resolution and the financial consequences of the resolution and the recovery, that could be 12-18 months depending on how each of these big cases play out. Barring the 2-3 large steel cases, the rest are all going through various phases in their resolution process. So I can't comment on the financial outcomes, but I want to believe that the slippages have started coming down. Formation of new bad has come down quite substantially for us for sure, and I would think for the rest of the industry too.
Wow, so no fresh negative surprises on NPL formation as well, I think is one takeaway. A couple of concerns, Mr. Srinivasan, if I can, which the reports seem to contain. One of them is, of course, about the targets that you've given for NIMs at about 3.2, if I'm not wrong, is what you've guided for the year. Now, people believe that primarily one, due to the rising costs that almost the entire industry will face, as also the rising competitive intensity would make this a slightly difficult task. Would you believe that as well, or would you believe this is a very, very comfortable target for you to reach?
Neeraj, nothing is very comfortable to reach. Everything is an effort.
Sure.
But I want to point out that this 3.12 that we have today is 3.32 that has come down to 3.12. And in part that's impacted by the higher slippages, which means higher interest reversals. So it's not necessarily the 3.12 going to 3.2 for a full year basis. It's really the 3.32 correcting itself to 3.2. So while it is an ambitious outcome, we've set ourselves some stretch goals. Our belief is if we continue to manage our credit slippages well, which is our sort of focus and confidence. Second, our credit CD ratio is in the 84, 85. So keep that going. As you know, we have a remarkable liability franchise, probably the only bank in the country which has 96% retail deposits. So I think the management of our deposit profile, the credit slippages being in control, and some degree of redistribution of the kind of growth between secured, unsecured, between retail, SME, business banking, corporate. So the balancing out should give us that uptick from where we are, but I must point out it's still lower than what we were. Yeah. So our belief is somewhere in the 3.2 is what we are sort of working very hard for. Well, but it's not a slam dunk. It's not easy.
Yeah, it's not easy. Of course, the street believes it's difficult, so I'm sure the street will be very, very happy if you manage to do that by the end of the year. My last question, sir, and that would be one concern, two questions rolled into one. One is that your fee income growth somehow has not been able to keep pace with the loan growth. What do you want to say there? And the IDBI Federal Life deal, I mean, given the LIC takeover of IDBI, how does that go ahead now?
On the second part, which is the question on IDBI Federal, as we speak, I have nothing to add or subtract from, because everything is, we all pick up from what you guys report in the media on LIC's investments in IDBI and the consequences thereof. We don't have any formal process that has stopped the exercise that we commenced, which may come through in the next 2-3 quarters as we get clarity from IDBI on their own future. So at this juncture, I don't have much to answer other than the fact that thankfully IDBI Federal as a company is continuing to do well, and they are sort of unimpacted or not impacted by the developments outside, which therefore as a big shareholder of the company we are pleased with. On your question on fee income, it's kind of up and down, because if you see the other income as the total income that we show beyond interest income has always had either a remarkable benefit because of treasury, or sometimes the treasury yields being where they are, we don't make the same kind of gains, treasury gains. But if you peel it, we will see FX has been growing consistently. Retail fee income is beginning to inch up, not substantially, but beginning to inch up. And the other area of trying to get the corporates whom we have started getting very good relationships to do much more than just credit. So you will see that the credit growth, which is north of 22, 24%, the fee income will start tracking in the late teens to early 20 very soon. And that's been demonstrated, but the net number invariably has either a treasury gain or a treasury lower profit, which sort of skews that number. That said, I still want to believe that we have a lot of work to do on that count, and there are some specific initiatives to make that come true.
Okay, and as they say, inshallah, all of these turn out to be true for you. Thank you so much, Mr. Srinivasan, for joining in today and giving us this perspective. Lovely talking to you, and look forward to talking to you more often. Well,
sure. Thank you.
Federal Bank Shyam Srinivasan talking about a very confident, I must say, very confident Shyam Srinivasan. Let's take a break on that note. Coming up, Future Group's latest attempt to crack the e-commerce market, a stake buy in London-based online fashion retailer Koovs.com. Agam speaks with Rakesh Biyani on the other side.
Hello and welcome. Well, I'm in conversation right now with Rakesh Biyani. He's the director with Future Lifestyle Fashions, and I'm here to take stock of what's really going on in the industry as well as his latest acquisition. Rakesh, thank you so much for joining us. And I'm going to start off with your latest buy. You have picked up stake in Koovs. We wanted to understand better as to what that brings for Future Lifestyle.
So I think if you really look at Future Lifestyle as a business, we run retail businesses in the form of Central and Brand Factory, At the same point of time, we have a portfolio of fashion brands. And our key brands are Lee Cooper, Indigo Nations, Colors, Jealous, and there's a series of those which are being retailed out of our stores and as well as out of other retail points across the country. And Koovs is a fashion specialist website focused on the India market, leading on both women's and men's kind of clothing. And it's sort of not like a typical fashion marketplace kind of scenario, but it's more of a curated fashion, very focused on the latest in fashion. All of these sort of work very well with the objectives of future lifestyle fashion. Our brand portfolio is a strong brand portfolio. We curate our fashion specifically for the different marketplaces that exist within India. And I think the synergy that we can bring together is substantial. And that's one of the main reasons why we have decided to take a strategic stake in Koovs, which is one of the most emerging fashion first or a fashion exclusive online marketplace.
Right, so Rakesh, from what I understand is that Koovs will also retail some of the future lifestyle brands as well. But talking about the current discounts in the e-commerce space, can you tell me a little more about how that will pan out for this arrangement that you have with Koovs?
Well, I think as I said, they're sort of Koovs is a different approach to, because it's more of a curated fashion business. It's not about really trying to sell the core products and not about trying to sell products at a discount. It's about bringing in the latest in fashion and bringing it fast. It's about converting trends on ramps at a faster rate and bringing it to the customer. So it's about really attracting the trendier customer, which is exactly what we do. If you really think about Central as a business today, it's brand.new. It's about buying brands and it's about really getting the latest and the newest products at our stores. Koovs is trying to do something very similar. And we think the fact that there's a lot of synergy in that process. Considering our sourcing strengths, which are already there in India, we can sort of bring in a lot more fashion faster onto the Koovs platform. Central is today only a 42 store chain, and in the future we would sort of look at expanding to maybe about 70 or 80 stores, but there's still a very large footprint across India, and we think that our brand portfolio and fashion portfolio through the Koovs platform will get a fashion exclusive marketplace, which is a non-cluttered, very focusing on a set of niche trendy customers, and that is what the objective of Koovs is, and which works very well with our Central brand objectives. Now, I think that's the journey that we want to follow. I think discounts, end of season sales, etc., these are all which are going to remain. I'm not saying that they're disappearing, but there's a different set of customer. We also are seeing very clearly that there is a lot more customers who want to buy the fresh product, who want to buy the latest in fashion, and they are willing to come at any point of time in our stores to buy it. Through the Koovs platform, I think we'll be able to create a much wider reach, and we would be able to sort of curate the reach also, which is what the real objective of the investment in Koovs is.
Right, Rakesh. So I'm going to talk about Central then. In that case, we do understand that you've spoken a lot about the right locations, choosing the right locations for Central, as well as working with the right assortment. In that case, with respect to the customers that you are targeting, what sort of changes are you bringing in assortment specifically? I reckon I can't say too much about location because that eventually will matter from place to place and market to market. But what can we expect when it comes to assortment? And perhaps if you could tell us a little more about your expansion plan in Central as well.
So when you think about the assortment that we've been sort of doing at Central, firstly you have to look at how we were sort of thinking hard about each of the departments that we are trying to offer at Central. And within each department, our objective has been to provide the right width, right brand mix, and a very wide assortment, so that we provide an enormous choice in each of the departments. So if you look at our renovated first store in Hyderabad, and we've got now an 18,000 square feet footwear section for men, women and kids, offering all the brands available in India under one roof, offering you an extensive variety. So when you sort of come into this massive departmental store, you get the widest assortment in footwear. The latest in trends, the best in class basics, So that is what we've been doing, and that we've been doing that across every single category, be it our women's ethnic business or the women's western wear business, or be it the men's denim business, and that's how we've been sort of building the assortment. Progressively, we've been started to partner with our brand partners, and we started working together on building certain collections which are exclusive at Central, which we started together trying to create awareness around, which is based on our trend forecast and bringing the latest in trend at Central and exclusively at Central. That's the sort of a direction that we've been sort of building our business. So I think Central has emerged significantly different from the marketplace. It has got the space, it has a much larger store. Each of the individual stores are typically about 100,000 square feet in size, which allows us to sort of celebrate each and every brand. And progressively, our focus is sort of ensure the fact that we keep celebrating new merchandise more regularly at Central. And that would automatically lead to sort of reduction in the number of days that we could sort of run promotions or run the so-called end of season sales. But our idea is the fact that we need to see sort of new first or fresh products first, which is the direction that we really want customers to really look forward to come and shop at Central.
Okay, Rakesh, then let me come down to some of your bigger brands like Lee Cooper. From what I understand, please correct me if I'm wrong, you're pegging that brand to be a 1,500 crore brand in the next 5 years. We also have several brands like Indigo Nation as well as John Miller's. My question here is the market at this point in time big enough for all the other players to also grow? Can you tell us a little more about competitive intensity in this market, considering you guys are also out there to build a niche for a certain type of customer?
So if you look at the the demographics of India, we are a very young nation and are becoming younger. With all the youth that are emerging, denim is a very, very core category, right? And for brand Lee Cooper, which is denim since 1908, has tremendous heritage, close to 110 years of heritage in just doing denims there. So, and that's the heritage that we sort of bringing together across the clothing line. And today we have Lee Cooper Originals for men, women and kids. So we sort of offered it across the board. And just recently, that is in effective April, we have taken over the entire footwear business in Lee Cooper, which is also a very large business. Cumulative together, they'll be close to almost about 700 crores or so this particular year. And that creates a foundation for the journey to about 1,500 crores. I think combine the strength of both the apparel and footwear with our own distribution and the very wide distribution that Lee Cooper is already available across, we believe the fact that the journey to our target of about 1,500 crores at wholesale in about 5 years is quite doable. And it's going to be driven by the rising income levels in India, the rising aspiration levels, and the authenticity of a brand like Lee Cooper. With the kind of price architecture that we have within Lee Cooper, we would be in a position to cater to a lot more customers and allow us to sort of achieve our objectives.
Rakesh, would it be fair to assume that you guys will focus a little less on end of season sales now, considering you guys are not concentrating so much on discounting and you're focusing a little more on just your brands and pushing them through?
So I would say that one of the other concepts in the group, which is Brand Factory, the Brand Factory concept has been in sort of nascent stages for some time. But last 3 years, we've sort of been able to ramp up that particular business. Today, we are going to be close to about 80 odd stores in Brand Factory. The traction is good. The brand acceptance is very, very strong. And that is our real discounting channel, which works 365 days a year. So as a customer, if you are looking at discounts for 365 days a year, Brand Factory is your destination. Now, and what we are trying to do is that, bring in synergies between Central and Brand Factory, where Central is about trend and new products. Brand Factory is about deals and promotions through the year. And that's how we sort of, that doesn't mean the fact that there won't be promotions and events at Central, but with the two working in tandem and the fact that market will keep maturing, aspirations will keep rising, Central is the first destination when you are aspiring for trendier products and you're aspiring to have the latest or the newest products first with you. That's what you would sort of come in. And the service factor, the environment, the assortment, the brand choice, all of those are things which will sort of be the differentiator in bringing in traffic to Central. So automatically we believe the fact that the number of days that we need to be sort of on promotion, because it's the way we are looking at the customer, will automatically have to start dropping, and that's a journey that we're already into. There's been some very interesting results of some of the work that we've done in the last 6 to 8 weeks, where we've been releasing our next season product early into the stores, and as there has been, even though there is an end of season sales going in, the new season product also is selling extremely fast, and that window allows us now to sort of ensure the fact that by the end of the season we've had a much higher sell-through, thus dependency on our end of season sales within Central will keep dropping. And that's a journey that will happen, and it's going to take some years of effort and being consistent around that, and we're quite committed towards that. We're working very closely with all our brand partners to ensure the fact that we can sort of drive that newness on a much wider spectrum with many more brands, and I think that would allow the fashion industry at large to sort of expand its base within India. But I think one has to keep in mind that this is a very large nation, quite a lot of people are there. There are going to be always multiple channels, and each channel will ultimately have one set of customer that would really prefer one channel to another channel.
Right, Rakesh, then my final question to you will be if you could tell us a little more about what you expect from a like-to-like growth in the near future. It could be a year, it could be a couple of years. And that said, what are the challenges that you are anticipating that you guys have already planned out and charted out to counter as we move into the next couple of years?
So I think there are, within the FLF business, I would say overall our objective is to try and deliver a double-digit same-store growth, but across different concepts we are likely to be at different levels. Clearly we see a lot more traction and a lot of growth happening in the brand factory business, with a lot of new stores as well as good strong like-for-like growth happening there. As I said, the concept is just about emerged into becoming a more matured concept. The team which is running it has settled, and the brand acceptance has become stronger. At the same point of time, as market sort of is transitioning, I think, and we are transitioning out of into a new way of doing business within Central, we would see sort of a more like a high single digit to a low double digit kind of a like-for-like growth, and close to about 7 or 8% out of new stores. So overall, still will be on a Y-on-Y basis come to a double-digit growth. On the brand side of our business, I think we have a lot of upside. We've been revamping those brands. We've re-energized all our core brands, and with footwear also becoming an integral part of our fashion business, we would continue to see high growth. So overall, quite poised to sort of be in the double-digit like-for-like growths and a high level of YOY growth. That's what FLF is likely to achieve over the next 3 to 4 years.
Fair enough, Rakesh, Biyani. We leave it at that. Thank you so much for joining us and taking us through your views and the outlook for the company.
Okay then, bye-bye.
Okay, thank you. Thank you so much.